Welcome back to the channel. In this video today, I'm going to discuss the loan estimate. We're going to go through all 3 pages of it in detail. This is going to be the first part of a 2-part series on loan estimates. As always, my name is Tobin Adams. I am a realtor here in Austin, Texas. Please call or text me if you're looking to buy or sell your home in Austin. Also, I am a mortgage broker. I'm licensed in Texas and in Florida. So if you're looking to get a mortgage or refinance your current mortgage in Florida or elsewhere in the state of Texas, please call or text. I'd love to work with you. Okay, so in the wake of the Great Recession, there were a couple laws that were passed. One was called TRILA and the other one was RESPA. And what it did was there's a series of things that came about as a result of the Great Recession, one of which is the Consumer Financial Protection Bureau. And what they decided to come up with was a uniform standard loan estimate. So that way when people got, when they reached out to apply for a mortgage from multiple banks and lenders, they got the same form, the same the layout of the form was the same, so that way it made it easier to compare one offer from the other, and that's the whole purpose of it. So let's go ahead and dive in. I'm going to go through it in detail and explain the different parts. This one I got directly from the Consumer Financial Protection Bureau, and it's dated from 2013. So the dollar amounts and the interest rates are not really reflective of today's market, but the layout of the loan estimate is the exact same, and the concepts are going to be the same, just the dollar amounts and the numbers are a little different than what you'd be looking at if you were to go out and get a loan estimate today. So in the top left portion is just some information about the applicants. And then also at the top, it's just going to mark off whether this is a fixed rate mortgage, the duration of it. Most common, you're going to see a lot of 30 years, whether this is for someone that's purchasing a home or refinancing, and how long the rate is going to be locked. And what that means is when you get a loan estimate, you will have a certain amount of time that you are allowed to close on that mortgage. And if you close within that time period, the rate will not change. It is locked. All right, now let's go down to the next section. It discusses the loan terms, just saying, what's the loan amount, what's the interest rate, what's your principal and interest. So there's something out there called PITI, principal, interest, tax, and insurance. So this is just the first portion of it. That's the principal and interest. And whether there is any sort of prepayment penalties or balloon payments. Nowadays, you pretty much are not going to see these. These were something kind of that left the market, that were maybe around leading up to the Great Recession, but nowadays you're pretty much any mortgage that you're going to get, you're not going to have a prepayment penalty. All right, now the second section is your projected payments. Now notice it's got it broken down into 2 different sections. The first one is years 1 through 7, and the second is years 8 through 30. And what this is showing is that for this person and this mortgage, they're going to have, so this is a conventional mortgage, and they're going to have mortgage insurance, but mortgage insurance will fall off of a mortgage once the loan to value ratio, the outstanding principal in the loan divided by the value of the home, once it gets to 78%, that mortgage insurance will drop off. And so that's why you see mortgage insurance for years 1 through 7, and then there's no insurance after that for the duration of the mortgage. And escrow is going to be like your taxes. So your taxes and your homeowner's insurance, which is also called hazard insurance. So every month you are putting, this person would be paying basically 1/12 of their annual cost for their taxes and their homeowner's insurance. And the servicer on this mortgage is going to collect 1/12 each month. And then when it gets time to pay it, because you're generally going to pay these for 1 year at a time, well, then they will have collected the amount of money that they're going to need for their homeowner's insurance and for their property taxes. And so then the servicer is going to pay that directly. So that's one thing that the borrower doesn't have to worry about dealing with. And 2, the fact that it gets broken up into monthly payments, it makes it a lot easier as opposed to being like a very large payment due 1 month, which can kind of be a shock for some people. Most people are going to get escrowed. So that is the second major section. And then at the bottom of page 1, we've got their estimated closing cost. That is the amount of money that this buyer is associated with closing on this mortgage. And then the dollar amount at the bottom, the estimated cash to close, that's the amount of money that this borrower needed to show up with at the day of closing to get their mortgage. And these two numbers at the bottom are broken out into great detail on the page 2. So we're going to go into page 2, and it's very nice. They've got it broken up into sections. So section A is the origination charges. So this is all of the fees and the costs associated just directly with the mortgage. And there's one word in there I want to point out that's called points. So when you get a mortgage, when you get a rate, it's very often there's a points associated with it. So that is a dollar amount that the borrower pays up front to get that rate. Sometimes it can be something that they pay, sometimes it can be zero, or sometimes it can actually be dollar amounts that the lender is going to give to the buyer in exchange for taking a higher interest rate. And I'm going to go into detail on that on another video. Section B are third-party services that you, the borrower, cannot shop around for. And I think a lot of these are kind of straightforward. Like the lender doesn't want the borrower going out and getting the appraisal done, because then that might create a potential conflict of interest, because maybe the buyer would want the property get appraised at a certain value, and so they very specifically don't let the buyer get involved with that. Also, the credit report fee, I think that's clear that they wouldn't want the borrower to get their own credit report. They're gonna the lender, the borrower, the mortgage company is going to do that directly. And then there's some other fees that once again the borrower is not allowed to shop around for that come from third-party services. Now we're going to go into section C. Section C are third-party services that you, the borrower, you can shop around for. If you look at the example that I've got, notice that a bulk of this has to do with the title. And there's one kind of catch, not really catch, but there's something unique to that. It is very common for the seller, as part of the negotiation, it is very common for the seller to pay for this title insurance. And as such, since the seller is going to be paying it, they generally are going to be the ones that are going to pick the title company. And so you, the borrower, wouldn't be the one that shops around for it. It would be the seller that could shop around for it. So if you add those up, that's our section D. And now if we go onto the right side of the page, at the top right, we've got some taxes and government fees. Section F is prepaid. And so there's a couple things I want to point out here. So first off, nowadays, you generally are going to have to pay for homeowners insurance, and it's usually not at least what I'm seeing is not a 6-month premium, but rather a 12-month premium. So the homeowners insurance for the entire year, and you're going to pay for that in advance. So that's definitely one of those big dollar amounts that shows up at time of closing. The second thing is prepaid interest. So this varies depending upon when the borrower closes on the mortgage. So if they close at the beginning of month, well, their prepaid interest, because it's based off of a daily amount, since there's a lot of days left in that month, it'll be a higher amount. Now, if they were to close at the end of the month, then there might only be 1 or 2 days, and so that dollar amount would be less. It's not something that the buyer necessarily saves or pays more for. It just varies depending upon the date of the day of the month that they close. Then the next thing is your initial escrow at closing. It's very common to see either 2 or 3 months. And the reason why, and this might be a little bit confusing, you're like, well, why are we doing escrow now if we're also going to be doing escrow when we make our payments? So they're generally going to want 3 months, maybe 2 months up front. And the reason why this happens is in a worst case scenario where a borrower has moved in their home and something happens and they fall behind on their monthly payment, or the service provider has to keep paying those monthly payments. So they're going to have to make the monthly payment for the principal interest. They're also going to have to be paying any monthly charges for the taxes, insurance. And so they'll generally put about 3 months in there, because once a borrower gets 3 months late on a payment, then that's when it goes into the unpleasant territory, where maybe they might get foreclosed on and they might lose their home. And so that's the reason why they're always wanting to have a little bit of a buffer, maybe 2 or 3 months that's just going to sit there in that escrow payment, and it's there for that worst case scenario. So hopefully this will never be a factor for you. It's something that's just going to sit there, and then you'll get that money back whenever you sell your home or you make that last payment on your mortgage. Then on section H, that is the title. That's where other things might go into. One of which is the owner's title policy. That's optional, but most people do it. It's generally a good thing to get. So then those get added up in section I, and then J is the total closing cost. So everything that's on the page, and it came out to $8,054. So if you look back on page 1, there's that $8,054 again. So that dollar amount is broken out into the detail in the sections that we just talked about. Then on that bottom section, on the bottom right, under calculating cash to close. So for this particular borrower, they had a closing cost of $8,000. They were putting $18,000 as down payment. So you add the 18 and then that deposit. So what that deposit was, which is also referred to as earnest money, that's something that the buyer had given the seller weeks earlier. When they first agreed to purchase the home, they gave that to the seller to let them know that, hey, look, we're not wasting your time. We're serious. We're going to buy this home. So they gave them some money up front. It's very common. You might see like 1%, maybe a little bit more as the down payment. As the deposit. So going back over those again, your closing costs of a little over $8,000. You add $18,000 and you subtract 10. And there's that $16,054. That is the amount of money that this buyer had to show up with on the day of closing. Generally speaking, it's going to be money that's wired in, and that's how much money that they had to show up with on the day of closing in order to get their home. And then on page 3, there's a few different bits of information on page 3. There's one that's really, really important. Whenever you get your loan estimate, I recommend you flip to page 3, and that annual percentage rate, the APR, you want to either highlight it or circle it. The APR is one of those numbers that one of the tools that you are going to use to help you decide which mortgage to go with. And I'm going to make another video, I'm going to go into detail on that. That's going to be part 2 of the loan estimate to explain that. And then there is some other information that's also on the 3rd page for the borrower. So yeah, that's it. That's the loan estimate. It's 3 pages. When you get them, really go through them. When you're working with your loan officer, ask questions, have a full conversation, make sure that you understand this in detail. So I want to thank you for watching the video. Once again, my name's Tobin Adams. Please call or text me if you're looking to buy or sell your home in Austin, or if I can help you out with your mortgage either for the rest of the state of Texas or in Florida. Thank you for watching. Have a great day.